In this video, we're going to look at Enphase Energy, and this is a solar company. And what I do in my videos is I run my discounted cash flow model so I could figure out what the stock of the company is really worth. And then I look at the financial ratios of the company, and I do this all with you on the video. So it's like we're doing it together. So let's get started with the model. So this company has a market cap of $6.9 billion. Let's see what they're trading at. They're trading at $55.14. So if you wanted to buy a share of stock, that's what it would cost. And now we need the free cash flows. And free cash flow is the cash that's remaining after paying your expenses. So if you're investing in a company, you'd want them to have positive free cash flow because you as the investor would like a return. Also, the way you value a company is you estimate the future free cash flows and you discount that number back to today's value. Now I'm going to pull the net income, which is the profit and loss on the income statement. And then we're going to pull the revenue, which are the sales for each year. So as you can see, there's some negatives in the numbers. There's 2 years with negative free cash flow, which means they spent more money than they brought in those years. And there's 3 years of negative net income. And net income is more accounting. In 2018, the company generated $12 million of cash flow, which means it brought in $12 million more than it spent in cash. But its net income is negative $12 million. Because the income statement used accrual accounting, so there were non-cash items that were passed through that year. So it can be a little more difficult to value a company with negatives. So I had to use a variation of one of my models in order to get a reliable value. But you can see their revenue is at its highest point in 2019, so that's a good sign. And they generated $161 million of income. So it appears once they pass the $300 million revenue mark, it becomes a profitable company. Hopefully that continues in the future. Let's look at the capital structure of the company because we need to figure out the discount rate we need to apply to the future cash flows. So they pay $9.7 million of interest on their debt, and that's on the income statement. And let's go to the balance sheet and see how much debt they have. We'll go to the liability section. And current debt is $2.9 million. That's debt due within 12 months. And long-term debt of $102 million. That's debt due after 12 months. So they pay 9% interest on their debt. They're a smaller company, so they don't get as good of terms as a larger company. And according to the income statement, they don't pay taxes. So the cost of debt is 9%. Let's get the cost of equity. We need the beta for that. That's how much the stock moves relative to the entire market. And they have a beta of 1.03. So the stock pretty much moves with the market. Now let's go back to the balance sheet because we need to look at the ratios later. So we need their current assets. Current assets are the assets that are used to run your day-to-day business. It includes cash, accounts receivables, inventory. And that's $500 million. And let's look at their current liabilities. And this is what the company owes within the next 12 months. And that's $199 million. And let's get their equity. That's the value of the company according to the balance sheet. $272 million. That's total assets minus total liabilities. And we also need their EBIT, earnings before interest and taxes. On the income statement, that's called operating income. And that's how much money the company makes on its operational business, but before it pays interest and taxes. So let's look at a capital structure. So the cost of debt is 9% and the weight of debt is 28%. The cost of equity is 10.2% and the weight of equity is 72%. So to get the weighted average cost of capital, it's a blend of the cost of debt and the cost of equity, and that comes out to about 10%. And that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows, and this estimation is based off of prior financial information. We also estimated Terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we'll get a value of the company of $5 billion. We divide that number by 125 million shares, and we get a calculated intrinsic stock price of $43. So that's what the model is saying the stock is actually worth today. But it's trading at $55, so it's trading at a 29% premium. So it's a sell, according to the model. Let's see what Simply Wall Street says the stock is worth. They're saying it's worth a little less at $37, so it's trading at a 52% premium, according to Simply Wall Street. It's fairly close to my number, but in both cases, the stock is overvalued. The stock price was really low for a few years, but it's been driven up the past year. So it seems like it's trading pretty high, but maybe investors feel the future of the company is really strong. The solar industry is a good industry to be in. Let's look at the financial ratios to get some more information. They have a bad price to earnings ratio. That's price of stock over earnings per share at 43. I like to see under 15. The average in the market is 27 and the median 17. They have a high price of sales also at 11. That's price of stock over sales per share. Really high price to book at 25. Price of stock over book value per share. I generally look for under 3.5 for this ratio. They have a good current ratio. They can cover their current liabilities 2.5 times. ROE of 59%, so they're providing great value to the equity holders. Interest coverage ratio of 11, so they can easily cover their interest payments. And they're fairly low in debt at 28%. So it looks like a pretty strong company with a good future. Let me know what you think of the video. Thanks for watching.